Welcome everybody to another Bond Smart Investing video blog. I'm Marilyn Cohen, President of Envision Capital Management in Los Angeles. Most of you have at some time in your life gone to a 3D movie. And as you know, things seem so real. They look like they're right in front of you, and you grab and you move your arms and you try to catch it and reach out because it seems so real. That kind of reminds me of what's happened the last couple of years with Ben Bernanke's quantitative easing. We all grabbed for higher yield because it seemed so real. It seemed like everything was going to continue on for quite a long time. Yet, when you think about it, I would say almost everybody I have spoken to, whether they're clients, family, friends, at AAII or money show conferences that I've given talks to, people always have said the same thing, that interest rates have nowhere to go but up. Fast forward to last week, and Ben Bernanke verified that, pretty much, that quantitative easing was in its last and final boarding process. So, people are freaked out. We saw not only the mayhem in the bond market last week in every sector, from treasuries, munis, corporate bonds, and of course collateral damage in the equity market. So, what should people do? Well, number one, don't freak out. We were all expecting this. And anybody who still has long-term bonds or long-term bond funds, shame, shame, because we have told you not only on our video blogs, but in articles on Forbes.com, regular Forbes articles, etc., that once interest rates start rising, not that it's going to be a bear market like 1994, but it's going to be tough to maintain the value of your capital. And that's what most baby boomers are worried about. So, what do? Like I said, you know intuitively that rates are going to kind of seesaw back and forth, back and forth. Is it 2.5% on the 10-year Treasury? That is our new baseline. Is it 2 3/4? Is it 3%? Well, the market's going to tell us. The Fed really doesn't have to do any kind of interest rate rises because the market is doing it for them. And that's based on the anticipation that the Fed will not be buying the $85 billion worth of treasuries and agencies and mortgage-backed securities per month. So, take a breath, take a look at your portfolios, take a look at how much you still have allocated in long-term bonds and bond funds, and shorten up those maturities and durations. So when interest rates rise another 25 basis points or go down another 25 basis points, you won't be uptight about the value of your principal. Baby boomers have not lived through a bad bear market in bonds. Most of the time throughout the 1990s and the early 2000s, boomers were in stocks, tech, you name it, anything that had an equity market type of component. And it wasn't until the credit crisis that baby boomers went all into bonds and bond funds. And demographics matter, everybody. They really matter because that is where the money's going, whether it's stocks, bonds, commodities. So you have to watch those capital flows, those flow of funds that we see every Thursday. What should you think about? You should think about what kind of investments you can make to preserve your capital while we are going through this intermezzo with the Fed. If you'd like more investment ideas and specific recommendations, go to my most current Forbes.com article or go on my website and take a look at some of my most recent Forbes columns. I'm Marilyn Cohen. Thanks for joining me.